Welcome to the weekly update, where I'll go over the action in the market for the week of March 4th through the 8th, and then we'll see how things look for the week of March 11th through the 15th. We ended up having a slight down week. We started off pretty good in Friday's session, and it looked like we were going to have an up week yet again, but we saw some profit taking coming in. So far, it looks like a pullback, but even declines can quite often start as a pullback. There are still some things that we want to be aware of, some concerns that we want to keep an eye on, but for the most part, the market is still looking positive. So before I start going through all of the charts, please know that there is a PDF available in the description below every video that I post. Some folks find this helpful to download and view this in a little different way. I've also started to upload at least once a week. So far, I haven't done more than just one each week, but it's called What to Watch, where the last video I do is the deep dive video. I go over the charts that I really didn't talk about. Then I go through and I make another video of the charts that I'm really focusing on. Please note that I go over all of the charts in the daily video and also here in the weekly video. So if you don't watch the What to Watch video and you're watching the daily video, there's going to be overlap there. Please know that I also post pivot points on the YouTube community tab. Also, this past week, I posted a couple of other things. I've also posted that in the Facebook group, but every day I at least post the pivot points, and these are updated each day on an intraday basis, and they're updated every month, but I update that with each day's new bar. I do have a private Facebook group that you're welcome to join. Not an awful lot of activity in that group. I'm really the only one that posts, and usually it's just a post that I have uploaded a new video. I've already posted a new poll for the upcoming week, and I'll be going through the previous poll here in just a moment. And I really keep a close tab on YouTube and Rumble comments. I'm really having to go through and delete a lot of comments on Rumble. I get some of these folks that all attended the same webinar or something about how to become a YouTube expert, and they don't even watch the video. They come in and they post something in the comments. As soon as I see that, I delete it, because at the end of each video, I also include my email address. If they want to be more professional and contact me that way, I can ignore them then, but it's very inappropriate for those of you that do find use in these videos to see all this garbage in the comments, either on YouTube or Rumble. And so I try to keep a close watch on that. Now, if you have something you want to say, you want to make a comment, either positive, negative, that's fine. I have no problem with that at all. It's the garbage stuff that really doesn't mean anything. That's the stuff I get rid of. And I also post not only on YouTube, but I post on Rumble as well. Sometimes I have some problems posting on either platform, and here's the link to the Rumble channel. Let's go back and talk about what happened this past week. We were down 0.28% on above average volume. We have been seeing volume really picking up. The technicals are still positive for right now. The decline that we saw in Friday's session, as I said, is still looking like a pullback for right now, but we want to keep an eye on that. It already broke through an upward sloping trend line that we've been watching. We're still above the 20-period moving average. If we fall below that, we'll turn a little bit more negative. But until that happens, we're just looking at this as normal profit taking. And it's about inflation and interest rates. We're going to get CPI, PPI, and retail sales in the upcoming week. Those are very influential. We just got done with the employment situation report, and that was why the market ended up opening higher. But there were some reasons that folks wanted to come in and take some profits, and that led to more selling. Of course, we also want to keep an eye on the geopolitical concerns. For right now, our trend on the weekly chart, it's still positive. The green line's on top, and it's still getting stronger. It's above the moving average. So that is looking okay. We're seeing a little bit of a mixed picture on the daily charts, where it's chopping above and below the moving average. We're still in a trending environment, and that trend is still positive, but it is possibly weakening. So looking at the different indexes, and this is from Friday to Friday, so my results are going to be a little bit different here. The Dow was down 0.9%, the NASDAQ down 1.2%, the S&P down 0.3%, and the one index that's really been lagging behind, the Russell 2000 small caps, it was the one major index that we follow that ended up being positive. Some bullet points just to take away. We did set new all-time highs on all the different major indexes, but stocks ended up declining on the week overall. So we set the all-time highs earlier in the week. The only index that was up is the one that's lagging, and that's the small caps. Earnings were released from big names like Target, Costco, and Broadcom, and they were pretty much well accepted. Economic reports are still supporting the idea that the market could see a soft landing, and that's what the market is anticipating right now. We have gone through some economic weakness, but or at least according to the market, they're anticipating that we're not going to go into a recession. Now, the debate is still out there. There are charts that you can look at, and I'm going to show you, that suggest that we could go into a recession. There are other charts that I show that suggest that we won't go into a recession. So we just kind of have to watch this unfold as things happen. This past week, twice a year, whoever the chairperson is of the Fed, they have to testify before the House and the Senate. And this past week, Fed Chair Powell did testify first before the House and then before the Senate. One was on Wednesday, one was on Thursday. The part that the market pays attention to are his prepared comments. That's on Wednesday, but then he says those same comments on Thursday. What the market also really pays attention to is the Q&A session when they're asking him questions to see, okay, well, how's he answering that question? What was the tone of his voice? Is he looking more positive? Is he more negative? But as that unfolded, it really didn't have much of an impact on the market. There's also a rumor that was floating around in Europe that the European Central Bank might entertain the idea of having a rate cut soon, but that's just a rumor at this point. It did help prop things up earlier in the week. Interest rates ended up closing down with the 10-year yield at 4.09%, and the dollar index declined as well. Both of those coming down did give some support to stocks this past week. I've been showing this chart for quite a while now. We're still in this downward sloping part with the blue line where inflation appears to be trailing off. The reason I show this chart is because if you compare 1966 to 1982 to what's happening right now, we saw a real move up in inflation. And there's a lot of folks out there. You could watch other YouTube videos. There's things you could listen to, your articles you could read that are going to say, yeah, we're going to go into sky-high inflation. We don't know if that's going to happen or not. And there are things that are coming together that might suggest that, but there's also things coming together that suggest that may not happen. We have to just wait until it actually starts to happen and just watch our charts as they give us more information. Then we're at 4.09% with the 10-year yield. We're still above that 4.02% that RenMac is determined. When we're above 4.02%, that's when it starts biting into corporate profits. But interest rates have been coming down. Here's the poll results from a week ago. The first question is, do you feel small caps are coming into favor, producing another false breakout, or need more positive confirmation before reaching a conclusion? And the small caps were up on the week, but they're still lagging behind the other indexes. And some of that has to do with rising interest rates. Smaller companies have to borrow more. And when they're borrowing and then having to roll that debt over, now they're having to roll that over into higher interest rates, and that really affects their bottom line. Anyway, according to this, 11% thought that small caps were coming into favor, 33% thought that it was another false breakout, and most of you thought that we still need more confirmation with that. The other question, the perma bears, these are the folks that are just sure the end of the stock market is right around the corner, followed by the end of the world, maybe not necessarily in that order, but they're just always just sure that things are going to be falling apart. And they're really coming out of the woodwork now. And there's a couple charts I'll show you later as to what they're really latching onto. But they seem to be coming out of hibernation. Actually, sometimes they never even hibernate. They're just always doom and gloom no matter what's happening. That stocks will suffer a massive loss going forward from here. Do you agree or disagree? 44% said that you agree with a severe downward move, where most of you still agree that it's not, even if we have a pullback, it's not necessarily going to be very severe. The next question, After some positive seasonality at the beginning of March, there's often historical weakness. Do you feel that stocks are going to go up or pull back? 33% thought that they were going to go up. And until Friday's session, that was the case. Stocks have really not been following the historical norms for right now. Now, that could change at any time, but these usual historical weaknesses that we've been seeing so far have not really been coming to pass, where 67% thought that we would see a pullback. And then the S&P closed above this long-term resistance at 5111, and we're still above that level right now. Now, we went higher than that, and we came down, but we're still above that point. Do you feel the S&P will stay above that level or drop back below it? 22% ended up being correct, saying that for right now, anyway, we're still above it. We're 78% thought that we would fall below it. And we did fall below it there for a while, but we were able to get back above that. Here's some Isabel Net blog charts. This is just, it's the only thing that really changes on this chart is the date on the bottom. I show this every week, and it's showing that things looking out into the future, whether it's Morgan Stanley or the consensus, suggests that earnings are going to continue to go up, which ultimately justifies stock prices going up. Then this is one of the charts that you could look at to say, we might be going into a recession. These are all employees in temporary services. That's the red line. This comes out around the time the employment situation report comes out. And when this drops below the red line, other times you see the grayed out area, that's when we've gone into a recession. And this has dropped down, but we have not gone into a recession yet. So this is one of the pro-recession charts. Now, like I said, there's other charts that I try to bring out in the various videos suggesting that we may not go into a recession. Sentiment is getting quite high again. It's at 1.4. It's above this dashed line. We're also getting we were rather extreme after Thursday's session. With the decline that we saw on Friday, we've actually dropped down from being extreme positive, and I'll show you that. This, if you want to stop and look at this, I've been talking about this chart from time to time. This is put out by NDR. It was originally brought to my attention by Chris Schiavocco from Schiavocco Capital, and I have a link to that YouTube channel on my recommended YouTube channels. So if you want to check out what he says, feel free to do that. This is a couple weeks old now. The takeaway from this is when the Fed is able to cut rates at a slower pace, that tends to be positive for the market because it's reacting to what's happening economically. Where when they have to cut rates really fast, that's usually in response to some kind of a really negative event that happened, like 9/11, the great financial crisis, or the COVID lockdowns. And there's a lot of problems going on at that point. And when interest rates are cut, that really doesn't help the price of stocks. And then we tend to see them underperform or sometimes even really decline. We just have one post to show you here from FactSet. They did make two posts, but it just applied to the Dow and it was kind of convoluted, so I'm not going to go through that. What they do is they listen into all these earnings calls. When a company makes their earnings announcement, that's what the market reacts to. And then after that, they have a conference call that thousands of people listen in on. Well, these folks listen in as well, and they're looking for key words that are being mentioned. And they're saying that it's really dropping with the companies that are mentioning recession calls. It's the lowest number since the end of 2021. And that's the chart right down here where it has been dropping off. They're still talking about it. They're still bringing it up, but not as much as they were before. But over here on this next chart, there's still a lot of folks that are talking about recession compared to a soft landing. We're still seeing the soft landing scenario not being mentioned as much, but it has been climbing recently. Then looking at our charts, here's the intraday chart going from Monday through Friday, where we ended up is kind of a boring day in Monday's session, but we did end up going higher. Then we saw a gap lower in Tuesday's session. This is when we broke down below that 5111 level, and we actually found support down here. That ended up lining up with the 20-period moving average for the QQQs, or the NASDAQ 100. We were able to bounce up off of that. We gapped higher in Wednesday's session. Then this is when Chairperson Powell was giving his first day of testimony, and the market was like, okay, good, bad, good, bad, good, bad. Then Thursday was the most positive day where we gapped higher and then saw some solid gains. We did start off really good in Friday's session, but then we saw a real pullback down here, and we tried to come back up, but we hit this resistance at the pivot point and then ended up closing at the low for the session, and that gave us a negative week overall. This is looking at just Monday through Friday, where the NYSE mid caps and small caps were positive, where the other bigger indexes ended up being negative over the 5 trading days. Going back to the beginning of the year, we have the NASDAQ 100, S&P doing the best. The mid caps, which also set a new all-time high this past week, they're positive. All of the indexes are positive, but you have way over here on the side, the small caps are just, they're really lagging behind. And a lot of that has to do with the rising interest rate environment. At least that's the conclusion that I've reached so far. Looking at our different sectors, we had a down week. So this is organized from what was down the most. We had discretionary being down. That's been a disappointment for the market. In a more solid environment, we wanted to see discretionary doing better. The tech sector ended up being down. A lot of profit taking there, and communication. These have been the more promising areas. Discretionary, not so much over the last maybe 4 to 6 months. They were really doing well in 2023, but they really haven't been performing all that great in 2024. But the tech sector and communication, that's been where it's at, and there was some profit taking there. Where you had energy, materials, real estate, and utilities. These have been some of the weaker areas of the market, and they actually saw some advances. Then I sort this according to what's called a scooter score. This is a stockcharts.com feature where the higher the reading, the better looking that particular sector, where we have the financial sector, tech sector, industrials, and communication. They're in the green area and they're above 80. We still have the energy sector, which is not doing so well these days. Then here's the relative rotation graph. And I try to remind folks, remember back to your geometry class when you worked with x-axes and y-axes. The flat line is the x-axis. The up and down line is the y-axis. When we're over here in this quadrant, that's a plus plus. And the strongest things are up in this area, right up here. We have communication. The financials are falling back just a little bit. And we're also seeing tech taking it down just a little bit. Some of the other areas, we're seeing a little bit of a pickup in staples, and this is over the last year. And we're also seeing a little bit of an improvement in healthcare, where we have energy way over here. This is the minus area. These are the weaker areas, utilities, and also looking at discretionary, which has been kind of a disappointment here. And real estate has also been rather disappointing. Then I have another chart, which is just looking at the indexes over the last year. I use the benchmark of the total ETF. It used to be the Wilshire 2000, but they changed that around. So that's no longer valid anymore. Where we have the NASDAQ 100 had been looking the best, but showing a little bit of weakness. The OEX, that's the S&P 100. Here's the SPX, which is the S&P 500. And then we have the mid caps, which have been showing some improvement, but then pulling back. The Dow, the small caps, which are kind of over here, and utilities have been one of the weaker areas as interest rates have been going up. Here's looking at sectors. This is just for the week, the 5 trading days. It's easier to say what was down. We had discretionary and tech because we had some profit taking. That's how it appears for right now. But going back to the beginning of the year, we have tech and communication doing the best. Industrials are slightly positive, with all of the other sectors being underwater. Looking at sentiment, we did get up above that 75 level, but after Friday's session, we came down to 71. But you have to look at the context of this. We were going back up and we were looking pretty positive, and we can stay here for a while. But now that it's coming down, we tend to use that as the contrarian indicator. So this is turning a little bit more negative. These are the active asset managers, which this is about a week old now, and they're starting to look extreme positive. So this is another suggestion that we're looking a little too optimistic in the market. Here's another look at that same chart coming in at 93.99, looking pretty extreme currently. We look at the VIX, which measures fear, and I've been noticing this more on the daily chart as well. You see where we're making a series of higher lows here? And we're not really seeing it as pronounced here on the weekly chart here with the bar chart. But that just means that fear has just kind of been increasing over a period of time. And that tends to go up when stocks are going down. Then looking at the ulcer index, this is just suggesting there's really no fear in the market. Here's the Ridex bear bull ratio, which is really quite positive, but there's a 1-day lag. This is as of Thursday's close. It's not taking Friday's decline into account. Then the latest reading, and this comes out once a week. This is Investors Intelligence. Of course, some people say, yeah, this is an oxymoron. It's like government intelligence or anaerobic glycolysis. How's that for a good oxymoron? But we're starting to get pretty extreme here with this reading, but it could still go higher. Then looking at the American Association of Individual Investors, they're looking pretty positive right now too, and just about getting into an extreme positive reading. When it gets up into this area, that's when we start to use it as a contrarian indicator. This is also positive for right now. When this black line is going down, that means that the tech sector is outperforming cash. It didn't outperform in 2022, but it has been performing in 2023 and into 2024. Here's some economic measures to look at. This is GDP, the estimate put out by the Atlanta Fed, where we're coming in currently at about 2.5% for GDP looking forward. When you look at the different forecasts out there, it's about 2.5% to the upside and about 1.25% to the downside. The takeaway from this is it's still positive. And that's what we see here on this next chart, because one part of a definition of a recession is the GDP is negative for 2 quarters. Here's some other GDP forecasts. Looking out, this is put out by Goldman Sachs. The black diamond in here, that's what Goldman Sachs is thinking will happen. I think that's right. Here, I guess they have Goldman Sachs in blue. This is the consensus, is the black diamond, where the takeaway from this, no matter what number they're coming up with, for right now, just notice that they are positive for GDP. We are seeing a real decline when we look at risky to not as risky bonds. When this is going down, that means there's not a lot of fear in the market. If this was really spiking up, that's when we get concerned. Also looking at the latest reading of the Chicago Fed National Financial Conditions Index, when we're below the black line, that means things are okay. This has been, well, it's a little old. It's February 5th. This shows that the tightening standards at banks have been decreasing. Also, this is a little old, the real-time SOM recession. Okay, the real-time SOM rule recession indicator. We're below the red line. That's when we get concerned, and when we go above the red line, and we're not even close. We're barely above the black line here. We get concerned when we go above the red line, when we look at the smooth U.S. recession probabilities. And then Brave Butters, this is actually kind of a recent reading here where we are coming down. We were getting a little bit concerned as this was going up, but now that this is falling back to the black line, that's more economic friendly. Looking at inflation, we did see some adjustments, and we're going to get a reading of CPI in the upcoming week. And this just adjusts on a day in and day out basis. But then it's going to start over once we hit April. Keeping an eye on the Fed. They're going to be meeting on March 20th. And as of right now, there's a 96% chance that they're going to keep rates the same. 4% of folks think that we might see a 25 basis point cut. This is how things have changed, and we really haven't seen much of a change from keeping rates the same. Now they're starting to look out into May, which will be on May 1st. There's a 75.9% chance that they're going to keep rates the same. If we start to see weaker economic reports, this is going to go down, where the idea of having a rate cut is going to go up. And you can talk to a bunch of different people, and they all have their opinion. We watch this just to get an idea of what may happen. And then this is how that has changed over time, where you're seeing less people thinking that we're going to have a rate cut, and now more people thinking that they're going to keep rates the same. And that's really what the Fed has been saying. Yeah, we're probably going to cut rates, and we're done raising rates, but we're not really going to tell you when. We don't really know if that's going to happen. We don't even know if it's going to happen in 2024. Here is the Fed balance sheet, which continues to decline. And then we look at it on a year-over-year basis, where it's also declining with their total assets. Looking at the breadth on a weekly chart, we're looking quite positive when we look at price and volume. And we're hanging in there pretty good and looking pretty solid on the daily charts as well. We are seeing a real expansion of new highs. They're not breaking out here on the weekly chart, but we saw a real upward move. It fell back in Friday's session, and we're actually dropping below the moving average on the daily chart, but we're still above the moving average here when we look at the 4-week moving average, and we continue to go up with the 10-week moving average. So this is looking internally in the S&P, and this is still hanging in there longer term. The advanced decline ratio is still above 0, even though it's been chopping sideways. That's still longer term positive. And accumulation distribution, a smart money indicator, is still advancing above the moving average. That's positive. Here's our trend where we have the green line on top. It's pretty much flattening out, but it's still on top, so it's positive. We're seeing the ADX going up above its moving average and the red line going down. So we're in a longer term, we're in a strengthening trend that's positive because the green line's on top. The Erin indicator is still positive. We have the green line on top up above. The red line's going down. The difference between the two is the oscillator. When the green line's on top, that's positive, and it's still going up. We're seeing a bit of an extreme positive reading on the daily chart right now. The mass index is not generating a signal. Here's the daily chart where in Friday's session, we did close down below this upward sloping trend line. And I'll show you that again. Here are the decision point scorecard results. There's been no change here. And the dates that you see, that's when these different signals were actually being triggered. We haven't seen any changes with the Keller market model, and this looks across different time frames and across different indexes. This still remains positive. Here's the long-term trend channel. We're still well above the midpoint and going up, so that is looking positive. This is a chart that I've really been focusing on. This is the R1 level, where a week ago we came up to this R level and then fell back. Well, then we were able to get above it, and then we fell back again. Then with the strength that we saw earlier in the week, we were back above this, and we're still above this level after Friday's close. Looking at our trend, we're still positive. The S&P is going up and the red line's going up and prices above the moving average. Our longer term trend here is also positive for the S&P. We're above the 0 point and going up with the McClellan oscillator. You could make a case for a longer term negative divergence here. S&P was going up, but we're not seeing a corresponding rise in this indicator. And we're turning back up and getting extreme with the summation index based on price. We're above 0 and advancing based on volume. That's still positive. The Swenlin trading oscillator is both above 0 based on price and volume and advancing. That's positive. And the bullish percent index, and we see pretty much the same readings on the daily chart and the weekly chart. The thing I like about this indicator is it's not moving average based. This goes in, it looks at all the point and figure buy or sell signals, and that's the result that we see. We're getting to an extreme positive reading, but this is still going up for right now, and it even went up in Friday's session on the daily chart. On a momentum basis, longer term, the PMO's going up. We're advancing based on price and volume and above 0. We did see a bit of a decline with the PMOs that are rising. The buy signals are still going up, but flattening out, and we're turning back up and just barely getting extreme with the PMOs that are above 0. We're not looking extreme right now with the percent B. That measures when we close outside of the upper or lower Bollinger Band. We did see one of those readings this past week on the daily charts. We didn't see any of those here on the weekly chart. When we look at the momentum, we're positive across the board here, but we're getting very high readings with these oscillators that could suggest that we're getting extreme positive here. The chicken money flow, it's falling back a bit on the daily chart, but it's still looking positive here. This is another smart money indicator, and we're getting extreme positive with the chicken oscillator. The force index, even though it did decline, is still above 0. That's positive. We're getting extreme with the money flow index, a reading above 80. And with the slight down week, the rate of change from this week to last week showed just a little bit of a downturn here. The rate of change falling back a little bit, but it's still looking positive. You could also make a case that once we go above this red line, we're starting to look extreme positive. The RSI based on 14 weeks is extreme positive still. And the weekly chart of the special K, it continues to be negative. It just can't seem to cross this red line. The daily chart has been positive for quite some time, but the weekly chart is just having more problems. The Stochh RSI on the weekly chart is still extreme positive. The Williams percent R is extreme positive. The ultimate oscillator is extreme positive. The vortex coming down, and we're seeing some weakness developing It's still positive on the daily chart, but we're setting a series of lower highs and it's kind of trailing off now. It's coming down after being extreme positive here on the weekly chart. We're rolling over a little bit with the Copic curve. And if we have an up day, the Copic curve is trying to turn back positive on the daily chart. If we have a down day, it's starting to turn more positive. It's right on top of its moving average as well. But this is showing signs of rolling over. We're not really hitting any of these lower levels on the longer term weekly chart. If we really start to fall, we'll be watching these fib levels and longer term moving averages. We are still declining with the 253 period simple moving average of the equity put call ratio. When this is going down, that is positive. But when we look at the VIX and the 3-month average of the VIX, we're still going up, and that is negative. Our different charts, we're positive with the hike in ASHI, we're positive with the KIGI chart, we're positive with the Renko chart, we're positive with the 3-line break chart. And the ease of movement, this has actually been flattening out quite a bit on the daily chart as well. We're still above zero and positive, but it tries to pick the path of least resistance. And right now that seems to be sideways according to what this is reading, even though we're seeing some healthy movement in the chart itself. This is something that's been pointed out in the daily version of the point and figure chart. We're going up and that's positive, but maybe we're going up a little too fast. This is a long tail up. Okay, we saw a top up breakout on the daily chart, and the point and figure chart is just thinking maybe we're going up a little too far, too fast. And some folks are thinking that we're in some kind of a bubble now. Other folks think that we're not. Longer term with our momentum here, with the long term, we're positive. We actually turned down a little bit, but we're still positive in the intermediate term. We declined slightly in the short term. And we switched over to neutral with the Elders Impulse System for the S&P 500, but the parabolic SAR, it's still positive on the daily charts. It's positive here on the weekly charts. Here's some daily charts. This has been a concern lately. We're seeing the blue line underneath the red line. This is an intraday chart based on 10 minutes. We want to see the blue line above the red line. Now, there are other times when the red line is above the blue line and we still go up, but it would show more strength if the blue line was above the red line. Here's a growth to value ratio for the S&P. We were showing some improvement, but we saw a pretty big decline in Friday's session, not really breaking out right now where it had been looking a lot more positive. We are still looking okay, even though we pulled back. When we look at small gap growth to small cap value, it broke out and it's maintaining its gains here, but we're not really seeing any corresponding breakout. And this is a daily chart of the small caps, where the mid caps are looking more positive. Yes, it has pulled back, but we've seen a longer term uptrend overall here, and it did set an all-time high this past week. The S&P growth to value ratio here, it was breaking out, but we're starting to see some weakness develop here, although it's still in a longer term uptrend. This is another area that's a little bit disappointing in one way. When we look at discretionary to staples, we're pretty much flat. We want to see discretionary outperforming. That's what happens in a more positive environment. However, we're in a solid uptrend when we look at discretionary by itself, where we're starting to see a downtrend when we look at staples. Here's the trend line. We had been staying above this. Well, we ended up closing down below it. That's the first line of defense. We're going to be watching on the daily charts the 20-period moving average next to see if price can stay above that. We are going to be coming into a new 50-day cycle that'll be happening on Thursday, March 14th. And I just look at this and use it as information. Sometimes it marks a top, a bottom. Most of the time it's some kind of a continuation. This is also an area of concern that at some point the markets may want to deal with. The S&P has been going up, but the transports S&P ratio is just continuing to go down. We want to see transports going up, and if anything, they're getting weaker. Looking at the broad market, here we are in March, where it tends to be a more positive month for the year. And this is just a weekly chart of the S&P on top, where we've been coming off of recent all-time highs. We did set an all-time high this past week of the mid caps. We're lagging behind here with the small caps. The Dow is in an uptrend. The NASDAQ is in an uptrend. The NASDAQ 100 is in an uptrend. Here's a daily chart also showing that we're in a pretty solid uptrend here. The mid caps are in an uptrend. The small caps, yeah, they're in an uptrend, but they're not breaking out the way the other indexes are. The NYSE is also back to setting all-time highs and in an overall uptrend. All stocks continue to be in an uptrend and setting highs. The 30 biggest software companies still positive, not setting all-time highs, but still with a positive trend. The FANG index kind of chopping sideways here a little bit, but still in a longer-term uptrend. ARC is still in a longer-term uptrend and not really participating in the big moves that we've been seeing. Here's the bank index. We want to keep an eye on that to see if things start to fall apart in some area of the banking sector. It was up on the week. We're starting to get extreme positive with the RSI. We're still positive here when we look at momentum. And we're still seeing more money going out of banks than going into banks when we do a year-over-year look. Then this is just a plain vanilla look at Dow theory, where we have the Dow coming off of setting recent all-time highs. The transports are just not doing that, and we're seeing more of a decline with the utilities. Looking at the broad market, the CRB index, it was up on the week, but we're still showing a longer-term downtrend. Oil, it's been going up here, but it can't seem to really break above 80. Copper showing a little bit of an improvement, but has really been chopping sideways as the economy tries to figure out, are we going to look better or are we looking worse going forward? The dollar did pull back this past week, and that did give some support to stocks. We're still in a longer-term downtrend. Gold, you got people that just think gold is it. And we are breaking out when you look at just the futures contract. Here I'm looking at the ETF, where we did set a new all-time high this past week. Silver, it's still in a downtrend, even though it was up on the week. Looking at interest rates, we're still in an uptrend. When we look at the total bond ETF, stocks are still outperforming bonds here on the monthly chart. We're still positive when we take the 1-month yield and subtract the 3-month yield. We should be negative, but we've been positive here for quite a while, and that's just something we're watching. Here is a daily chart of the yields where they had really been declining, and then we started to level out. They were going back up. We saw a bit of a decline recently here, and that's been supporting stocks. Here's a weekly chart looking at the US, UK, German rates, which did decline this past week, where Japanese rates, that's the red line, were pretty much flat. This is a chart that I've been showing for quite a while, that when we spike up, and this is when we spiked up to 5% with the 10-year yield. We're still waiting to see if anything's going to play out there, because other times when we see a spike and then this really start to go down, that usually means something bad happens after that. And we're just keeping an eye on this. This chart is still suggesting pretty much the same thing, that a lot of times when we hit a high level and then turn, that usually means there's some kind of a bubble. Looking at some relative studies, here's the intermarket analysis chart. Oil is still up the most, followed by stocks. Then we have gold and then the dollar. Bonds are the only thing that are still negative going back to the beginning of the year. The NASDAQ 100 to S&P 500 ratio still shows that the NASDAQ 100 is outperforming. The S&P 100 did pull back, but it's still outperforming the S&P 500. Growth is still outperforming value, even though it's pulling back slightly here. Gold is still underperforming stocks, but it did see a bounce up as we've been seeing a breakout in gold. And with weakness in the dollar and strength in the gold, we're seeing this ratio going back up. Bonds on a shorter term chart are still continuing to underperform stocks. The low volatility stocks, especially when you compare them to the S&P, they continue to decline. Discretionary is still outperforming staples, and the energy sector is underperforming the tech sector. And then our longer term look at some positive setups. This is the NYSE breadth thrust. We're still working off of that signal that was generated in October 2022. That's long-term positive. The SWAG NYSE breadth thrust, we've had 2 signals over the past year. This tends to stay on the books for about a year, so we're coming up to this one falling off. Then we have the other one that was set back in October, which will remain on the books. The Zohorchak method, it came down and now it's starting to go back up, and it's giving a full-on buy signal. We're still above this longer-term trend line with the weekly chart of the S&P. And here's a shorter-term look at that same chart where we are breaking out above this line. When we look at the NYSE, new highs minus the new lows, we're above zero and advancing. That's showing longer-term internal strength. Here's the S&P new highs minus the new lows. This is also showing that things are positive internally for the S&P. We're still above this trend line when we look at the NASDAQ 100. So that's holding up for right now. This is one of the charts that the perma bears are really latching onto. We came up and we set a high back in 2000. This was the dot-com boom, then the dot-com bust. This is measuring the NASDAQ 100, which are growth stocks, and comparing them with the Dow, which are pretty much considered more value stocks. And that really started coming down, and it took us many, many years to get back up. We came back up to the same reading at the end of 2021. Then we went through 2022. We're coming up, and we're still just a little bit above this ratio right now. So we want to watch this. Is it going to continue to go up, or is it going to start to fall back? If it continues to really come down, of course, that would be more negative. If it could break out and set a new high that actually lasts for a while, that would be more positive. Here's another kind of the same look where we look at the QQQs, which is the NASDAQ 100, comparing them to the small caps. We did show a really high reading, and we're starting to fall back. So this is the chart we're watching, but this is quite long term. We are still seeing an improvement when we look at the cumulative new highs minus the new lows for the NASDAQ. And we're still above where we were with the 3-month yield from where we were back in 2007. If we really see this start to just fall off a cliff, that might mean we're entering some kind of a difficult financial time, because that's what it meant when we entered the great financial crisis. So this is just for Monday's session. What is the outlook? The technicals are positive, and for right now, the decline that we saw on Friday looks to be just a pullback, and it was a pullback on lower volume, so that's somewhat positive. We're still above that longer-term overhead resistance. We're also at some point possibly going to experience some weak historical seasonality. We're not going to have any economic reports on Monday, and we want to keep an eye on the different geopolitical events, but the market's really not paying attention to that. Here's the upcoming economic calendar. We're going to get CPI on Tuesday. Then this is kind of strange to have them come out on the same day. We're going to get PPI and retail sales coming out on Thursday. Another one that I think is important is industrial production and capacity utilization, as well as consumer sentiment. Those will be coming out on Friday. This is another chart just to kind of give you everything in one solid picture. Where it's different from the chart that I just went through, it actually shows you the forecasts when they're available and what the previous readings were. Seasonality, we do have a positive seasonal day for Monday. We're up with the Dow and S&P, where we're neutral to positive with the NASDAQ. Now we're coming into options expiration week, where we tend to be up 66% of the time and down 34% of the time. And then we'll be on the 7th trading day of the month, where we do see a little bit of a tick up here. But be aware of this negative seasonality. The market has pretty much ignored this for the most part. Is it going to shift and suddenly start paying attention to that? This is a longer term look where sometimes we see some weakness from now going into the latter part of March. And most of the gains that we see are after we see this dip here and then going into the end of the year. We also look at this when the sitting president is running for re-election. That's the black line, where historically we've seen some weakness right about now, but it's not really showing up based on price action. Monday is the most positive day of the week based on what happened in 2023, so that tends to be an up day. And March tends to be okay, not the best month, but it's certainly better than February was. And February ended up being a pretty good month. This is from Dan Bird. This is also suggesting historically we might see some weak seasonality here. And then this is a chart that I've been showing for a while. We're still kind of following what happened in 1982, and then we saw this going back up, and that led to good things after that. 2023, this is about when we hit the low, and we've been going back up since then. We're wondering if it's going to follow a similar path. Then looking just at the month of, this should be, okay, this is for February. It should be for March. This is an erroneous chart. It's more positive for the month of March. And here's one that's looking more positive, where we're up 11 out of 18 times for the S&P, down 7 out of 18 times during an election year. Tom Bowley also has done some research where we're still we're coming out of this period where we should have seen weak seasonality, but we didn't really see much of that. Now we're coming into another time of positive seasonality. So our warning signs, this is based on how things closed on Friday. we're seeing some potential signs of weakness when we look at growth versus value. Not so much for the small caps and mid caps. That's holding up. What we're really focusing on here is the S&P growth to value ratio, and discretionary as a bit of a concern. We see a lot of negative divergences here when we're looking at our daily charts. And I won't just go ahead and pause this and look at what this is. The one that's really the most pronounced right now is the transports, the Dow and S&P. And stocks are potentially entering a period of seasonal weakness, but it's kind of been not really paying attention to that for right now. These are longer term lines or longer term warning signs that we look at where we're still above those long-term weekly trend lines when we look at the S&P and the NASDAQ 100. The longer term NASDAQ to Dow ratio is at previous highs. We're trying to break a little bit above that. If we really start to break below that, that would turn more negative. And then we look at the QQQ to IWM ratio. It is declining after getting back to setting higher readings there. The 1 to 3 month short-term bond spread continues to be positive where it should be negative. And the cumulative new highs, new lows for the NASDAQ are improving. The 3-month yield is back above where it was back in 2007. What we're really watching for to see if that really drops, that could signal some kind of a financial problem. And then earnings season is either positive or negative based on how the market reacts to that. On the positive side, our equity put call ratio based on 5 periods is going back down. When that declines, that is positive. The parabolic SAR chart is positive. The Kopic curve is kind of trying to go positive. It's pretty much on top of its moving average. The vortex is positive, but as I said earlier, is setting a series of lower highs and kind of trailing off. Small and mid-cap growth continue to be positive, and the financial sector is positive. Long term, the daily special K chart is positive, but as I just showed you, the weekly chart continues to be negative. Our longer term equity put call ratio based on 253 periods, because that's really the actual number of trading days in a year, it's going down. So that's longer term positive. The Zohorchak method is coming off a full-on buy signal. The Russell small caps and mid caps, they are in positive trends, including all the other indexes. The new high, new low study for the 50 periods for the exponential moving average study, that is positive. And when we look at the S&P new high, new low study, that's also positive. We've seen 2 ZWAG NYSE breadth thrust buy signals that were generated over the last year. As I said before, the March one is going to fall off because these are usually good for 1 year. Seasonally and historically, March is usually a positive month. Doesn't mean that it's going to go straight up or straight down. And the longer term positive seasonality and setups are still there. So our conclusion, this is just for Monday. We're still positive. We're pulling back on lower volume. We're still above that overhead resistance at 5111. And we potentially are in some weak seasonality, at least historically. That's what we're watching in our short-term chart versions. Intermediate term, we are dealing with somewhat of an overbought condition, but we're still above that resistance. In the long term, we're also overbought because we have a 150 and 200 period moving average that is still extreme positive. Thank you. I really hope you found this helpful. I will be posting the intermarket analysis video, the deep dive video, and the what to watch video. So I hope you have a really good weekend, and I will talk to you in the next video.